Welcome back to Explain the Charts, your premier destination for high-level technical and fundamental market analysis. Today is March 25th, 2026, and we are looking at a very interesting setup for the USDCAD currency pair. The market is currently navigating a sea of geopolitical uncertainty, primarily driven by the ongoing situation in the Middle East. Recent reports suggest a cautious shift in sentiment as the United States has reportedly postponed military strikes on Iran. This news has introduced a temporary risk-on vibe, yet the Canadian dollar remains under significant pressure. The primary reason for the Loonie struggle is the volatility in the energy sector, as crude oil prices have eased significantly. Since Canada is a major oil exporter, the CAD is highly sensitive to these price drops, making the USDCAD pair particularly volatile. Furthermore, the US dollar remains firm as market participants digest hawkish expectations regarding the Federal Reserve's next moves. Even with softer PMI data coming out of the US, safe haven demand is keeping the greenback afloat. Analysts are currently watching the 1.3730 level as a decisive breakout point that could dictate the next major trend. Let us dive into the daily chart data to see how these fundamentals are translating into price action. Looking back at the start of the year, we saw USDCAD trading significantly higher, reaching levels near 1.47 in early February. However, since that peak on February 2nd, we have seen a gradual correction followed by a period of intense consolidation. The chart shows a notable downtrend through late February, finding a floor around the 1.35 level in early March. From that support zone, the bulls regained control, pushing the price back up toward the 1.44 range by mid-March. More recently, the pair has retraced again, and we are now seeing it stabilize in the 1.37 range. Notice the high volume on the downward moves earlier this month, suggesting strong selling pressure that the bulls are now trying to absorb. The current daily candles show a cluster of activity around 1.3750, which matches the news reports of a two-month high attempt. If the daily close stays above 1.3730, it would represent a significant structural shift for the pair. We need to be wary of overbought signals, as several technical indicators are starting to flash exhaustion at these levels. Switching over to the 1-hour chart, we can see the micro-movements that led to our current position. In the early hours of March 24th, the pair showed a steady climb from 1.3711 all the way up to 1.3757. This move aligns perfectly with the news of the US dollar regaining strength despite mixed economic data. However, look at the resistance around the 1.3780 area. The price struggled to maintain momentum there. The 200-hour moving average, which currently sits near 1.3687, is serving as the primary floor for the short-term trend. As long as the price remains above this confluence zone, the technical bias remains cautiously bullish. We saw a sharp reversal earlier in the week following political headlines, which briefly sent the pair back to retest support. The hourly candles are showing smaller bodies now, indicating a period of indecision as traders wait for the next catalyst. Keep a close eye on the volume during these consolidation phases, as a spike usually precedes a breakout. The 1.3755 level is the critical pivot for intraday traders looking for long opportunities. Now, let's zoom in even further with the 15-minute chart to capture the most recent activity. In the last few hours of March 24th, the pair has been range-bound between 1.3750 and 1.3765. The candles are quite small here, reflecting the market's wait-and-see mode ahead of the UTC morning sessions. We can see a small support level forming at 1.3759, which has held multiple tests in the last 2 hours. The 15-minute timeframe highlights the sensitivity to every minor headline regarding the US-Iran discussion window. If we see a break below 1.3755 on this chart, it might signal a short-term retracement toward the 1.3730 area. Conversely, a push above 1.3770 would likely trigger buy-stop orders and accelerate the move toward 1.3800. Notice the tight spread and consistent transactions, suggesting that liquidity is high despite the narrow range. Traders should look for a stop run below the recent lows before a potential move higher. This time frame is excellent for identifying the exact entry points once the daily bias is established. Returning to the daily view, let's summarize the key price levels for your trading plan. On the resistance side, 1.3755 is the immediate hurdle, followed by the major 1.3803 level where the 200-day moving average sits. A successful break above 1.3800 would open the door for a much larger rally toward 1.3900 and beyond. On the support side, 1.3730 is the most critical level to hold. A failure here would likely see a drop to 1.3680. Further down, the 1.3650 and 1.3580 levels remain the ultimate safety nets for the current bullish structure. In the short term, I expect the pair to continue its cautiously bullish trajectory, with a 65% likelihood of testing 1.3800 this week. This bullishness is predicated on oil staying below $90 and the Fed maintaining its hawkish tone. However, if we get a sudden de-escalation in the Middle East, the US dollar could lose its safe haven premium quickly. Under that bearish scenario, a reversal back to 1.3640 is highly probable, especially if oil prices rebound. Always wait for a candle close above or below these levels to confirm the validity of a breakout. To recap, USDCAD is at a major crossroads where geopolitics meet technical resistance. Watch for the 1.3730 support to hold and look for a decisive move above 1.3755 to confirm the next leg up. The correlation with crude oil remains the strongest factor to watch alongside Federal Reserve commentary. Be careful with over-leveraging in this environment, as Truth Social-style headlines can cause instant reversals. Thank you for watching Explain the Charts, and make sure to subscribe for more in-depth market breakdowns. Please remember that this analysis is for educational purposes only and does not constitute financial advice. Always conduct your own thorough research and consult with a professional before making any investment decisions. Trading foreign exchange involves high risk and may not be suitable for all investors. Stay disciplined, watch the levels, and we will see you in the next video. Good luck with your trades for the remainder of March 2026.